things are changing and what we can expect. I'm also going to do this through the medium of looking at investment property, and that allows me to bring in the various different sectors. One of the headings that I'm going to talk about is this area of what I describe on the screen as coordination and cooperation. And really that might be a little bit vague at the moment, but I'd hope that at the end of the presentation you'd understand what I'm talking about. And it will bring in some of the themes that the other speakers have spoken about. Before doing so, it would only be right and proper to acknowledge that the property industry have been lacking in skills and foresight. And I'm particularly at the forefront of that on the basis that I'm one of those people who bought a house in 2006. So my appreciation for what might happen in the future should be certainly treated with a healthy level of scepticism. In any case, it may be that our industry is still shell-shocked from what has happened over the past few years. And that's understandable, but maybe when we're looking into the future, we're perhaps as a result of that a little bit too cautious. One thing which is for certain is that it's going to be less exciting, but it should therefore be a little bit more stable. It is highly unlikely that we will return to a boom-bust cycle, but instead it should be a more level marketplace and perhaps with some sustainable growth. I'm nervous about using the word growth, and I am going to talk about funding and the implications that exist at various stages throughout the presentation. But using the words recovery or growth in any presentation are utterly meaningless when funding isn't available. And I think everybody in the room acknowledges that funding, in terms of traditional funding from Irish lenders, is very limited, and therefore we have to go to external sources to solve our problems. So moving on and talking about investments and the type of things that we're going to expect. Since 2011, we have seen increased interest in Irish property investment, predominantly from overseas investors, be they English, Israeli, German and North American, and some Middle Eastern. Recently, Duncan Lister, a colleague of mine, and I went to the United States, and it became very clear to us that both private individuals and funds have a strong desire to be active in the Irish market, and clearly they are not deterred by the Irish economy. Indeed, Duncan and I left the United States with a strong feeling that within Ireland we are much more negative about our prospects than those who are on the outside looking in. From an external perspective, it may be that these investors believe that they are in the main buying international covenants and not perhaps the Irish economy. But in any case, for those taking a long-term view, and I'm talking about a long-term view and property investment should be framed in that, there can now only be an upside for property values. The recent budget has given us rent review certainty, it's given us reductions in stamp duty, and it's given us changes in capital gains tax for property investors. So what's the future going to look like, or the next 12 months? As I said at the beginning, it's very hard to know, but what is clear is that there is ample investor appetite for the Irish market, and it is a market which is capable of absorbing anywhere between 750 to €1 billion worth of transactions on an annual basis. However, the vendors of these assets have to get real. The purchasers who are out there want to buy prime assets, and they're going to want them at a price. Obviously, and as a result of the change in rent review legislation, where we now have properties with upward-only rent review provisions and those with upward and downward provisions, a two-tier market would exist. All other things being equal, I think, I'm not sure if that was somebody from the Retailers Association interrupting my presentation. All other things being equal, I think you can expect perhaps maybe a 1% yield differential between those properties with and without. There's going to be an ongoing desire for overseas investors to buy assets, but the lot sizes on which we offer our assets actually are not akin to what they're looking at. When Duncan and I were in the States at the end of January, we sat down with numerous investors, and I remember one of them saying to me, look, Ireland is a long way, I've been over there already, if I'm going to spend 5 hours in a plane, I'm going to want to spend a minimum of 300 to 500 million before I start buying things. Where's the portfolio? If you look at the screen behind me, these are the principal investment properties which are currently available on the market, and in total they do not add up to 80 million euros. So we're going to have to move and evolve about how we bundle and package our investment property. I mentioned funding, and I'll come back to it later, but traditional funding is clearly not available. Loan-to-value ratios are going to change, and there is certainly an opportunity for new, non-traditional lenders to come into the market. I'm by no means bright enough or smart enough to figure out exactly how they're going to do this, but there is a void to be filled, and we're going to see a more inventive type of finance being provided. For a large part of the last decade, many looked at Ireland from overseas, and they wondered why our yields were so low. The reason that was given was that Ireland has an exceptional case for rental growth, and this was both untrue and unsustainable. In the current climate, it is our experience that occupiers, and occupiers are the people who derive investment value by creating the tenancy, are demanding shorter and more flexible leases. And it is possible that lease lengths in this country will move Ireland from a current market, which at the moment is most comparable with the UK, closer to a more European lease structure. It's not necessarily a bad thing, it's just different, and it's going to take us time to get used to it. If you consider in the 1980s we had lease lengths which were 35 years, in the 1990s they were 25 years, in the 2000s they were 20 years, and at the moment the type of leases that we're typically witnessing are about 10 years with break options at the end of year 5. I don't believe that we're going to go back to that 20-year lease structure, and I do think that the model will move more towards the European system. From the investor's point of view, looking at those new lease structures, it means that there is a less predictable income stream, and consequently there is a higher risk, and therefore you're going to want a higher return, and that leads to a depressing in values. It is also going to mean that it is harder to justify development of new property. In order to get any development funded, rents are not going to be at market rents, and Aoife already touched it in her presentation. In a sense, any pre-lets are going to be on the basis of an economic deal and not necessarily a market deal. It is possible that for pre-lets, where we usually had a situation where there was rent reviews at the end of year 5, that the tenants are going to sign into fixed term leases with no increases, or a fixed increase at the end of year 5, or maybe it's at the end of year 7, but certainly the rule book that we had previously is going to be torn up, and it's a new market. If you accept that premise, and that it's going to be difficult to fund new buildings, then it's also going to be difficult to fund refurbishment opportunities, and the similar issues will arise. The rent review legislation, the changes in it, is going to lead to greater volatility in rents, and that works both for tenants and landlords, depending on where they are in the economic cycle. From an investment point of view, this may make Ireland less attractive from overseas purchasers, especially when you compare us with our nearest neighbour. Given the lack of local capital which is available in the medium term, this is perhaps not good news. Irish long-term average yields have been very much aligned with some of the UK regional cities, be they Manchester or Liverpool, and that's what you would expect because our lease structures have not been dissimilar. Changing the lease structures to the type of structures that we're now involved with is going to move our market closer to that of smaller economies across Europe. So we're going to get into a different comparable market. In theory, and certainly when I was in college, and I'm looking at some of the DHP lecturers who were teaching me there, I was always told that yields should reflect the risks and the rewards that were available to investors. Larger, robust economies such as the UK or Germany should offer less risk than Ireland, and intuitively they should be priced at a keener level. However, the differential between Ireland and those economies over the past 20 years has been non-apparent, and this was down to the perceived tiger growth that I referred to earlier on. Therefore, the changes to the leases will see our yields at about 100 basis points or 1% higher than the historical long-term averages that we have been used to. And that translates into a reduction in capital values somewhere between 15 and 20%. Now, to be clear, I'm not saying that the yields are going to shift off where they are at the moment. I'm saying that that difference is already priced into the market. But if you're sitting here and you're waiting for the yields to go back to their long-term historic averages, I don't believe that's going to happen. If I could move on and look at a different form of investment, and this is the buzzer from the house that I bought in 2006. And the provision of residential rental property to date has mainly been provided by private individuals, either directly or via pension-wrapped products. Over the past number of years, the government has directly or indirectly introduced a number of measures, including higher PRTB fees, the non-principal private residence charges, a reduction to 75% in mortgage interest relief, and you have to pay the universal social charge on all rental income. All of the above will act as a major deterrent to residential investment and will lead to private investors withdrawing from the market. In major urban areas, this will lead to a shortage of rental property and, in my opinion, will actually increase rents. However, there will be a new breed of residential investor who will fill the void, albeit not necessarily providing the type of product that the market will desire. These investors will purchase large-scale single-block investments, such as the ones behind me on the screen. And whilst this is not new to Ireland, it is something that got pushed aside over the past 20-25 years. There is very strong and clear demand from overseas investors, mainly from the US and Germany, for this type of product, and they are certainly familiar with it as a form of investment. It's our opinion at the moment that in terms of pricing, and certainly from the feedback that we're getting from these potential purchasers, that the market is not perhaps cheap enough for them to come into yet, especially considering that you can buy dry investments on somewhere like Grafton Street at a yield of about 6.5%, which would have substantially less asset management than residential investment. As I expect many of you know, residential investment requires significant capital expenditure. There are voids, there's repairs, redecorations and renewals. And for those reasons, the returns will have to be higher. Investors targeting individual asset classes now and in the future are going to have a much better understanding both of the business that occupies the unit and actually the physical characteristics of the unit that they occupy. So the investors are going to become substantially more sophisticated than they have been heretofore. Consequently, tenant profiling and unit profiling will become more sophisticated. If I can take, for example, and explain that a little bit by what I mean and use the retail market, clearly there have been substantial structural changes in how retailers operate their business, and it's left certain types of retailers vulnerable. Those who did not adapt to the increase of the internet and the impact of the internet have all but disappeared. And what was described previously as a bricks and mortar purchase experience, I read recently described as a clicks and mortar experience. That is to say that retailers need a physical presence, but they also need an online presence. And if you take somebody who's a really good online presence, Next, they're somebody who's been in the market here for a long time, but their physical presence has also increased. And the size of the units that they now occupy is double what they used to occupy, so it's almost like a showroom. Scale for retail is really important. And if you think about shopping centres like the Square in Tala, when that was built, my understanding is that unit sizes were approximately 800 square feet on average. Dundrum Town Centre, the unit sizes are now about 1,600 square feet. And dare I say it, but if another shopping centre was to be built in the future, the unit sizes, I suspect, would be larger again. From an investor's point of view, if you're looking at retail, you need to be conscious not only about who your tenant is, but the physical characteristics of that unit and how adaptable it is for other users. Again, in the retail market, I think we expect a polarised market developing, perhaps with the middle market suffering. So it's going to be big players versus niche, or it's going to be high-end versus low-end. So it might be Brown Thomas and Pennies, but those who are in the middle ground are going to get squeezed. And again, investors are going to be profiling these type of properties to see how this fits in with the portfolio. Bizarrely, there may be an opportunity for long-term investors, or maybe I should describe them betterly as opportunistic buyers who don't require an income return, to consider land purchases. And I'm not talking about the type of land on the screen behind me. Clearly, they're going to be in urban areas, and there must be absolutely no possibility of the dezoning that was referred to earlier on. The new capital gains tax waiver will be an enticer for such speculators, and in many ways will act in a similar way to the SSIAs did for private individuals. The office market is, in my opinion, a special case, and it's a market which is almost on the cusp of recovery. The IGA created 13,000 FDI jobs in 2011, which is an increase on 20% in 2010. This year, they anticipate that they will create 12,500 jobs. And a recent study carried out and released this week on behalf of Matheson Ormsby Prentice stated that FDI companies believe that they will have 20,000 more employees over the next 3 years, with 75% of those related to the financial and technology sectors. Of those surveyed, only 3% believe that there would be a reduction in numbers. Most commentators believe that there will be strong growth as a result of the dwindling supply in the office market. And the interesting thing about the office market is when growth returns, it returns with a bang. I suspect Austin would be horrified with the type of percentage increases that have happened in the past. But if you look at this graph going back over the 1970s, there are years with 28%, 29%, 15%, almost 22% year-on-year growth. And that is because it is a real supply and demand market that takes an awful amount of time to turn on the tap. As matters stand, we have nothing, and I mean nothing, under speculative construction. And as a consequence of that, with the requirements which are out there in the market, the supply will dwindle and growth will return to the market faster, quicker and higher than anybody anticipates. Surprisingly, we have not witnessed any impact on yields, and you would expect that over the next 12 to 18 months there will be some compression in yields for office property. In summary, the investment market is, as I said at the beginning, going to become dominated by more sophisticated investors. I think in Ireland it's going to become dominated by overseas players. They're going to have a breadth of experience. They may specialise in a particular sector, and they are going to have deep pockets which will enable them to take on the inherent risks that are associated with property investment. It is a long-term investment and not something for the quick buck. Again, they're going to get into this tenant profiling and this unit profiling. If I can move on from that to the second part of the presentation, and this is about cooperation and coordination. I mentioned at the beginning that I thought various stakeholders will now enter a period of cooperation and coordination, and it's absolutely necessary, and it will be witnessed across a number of different sectors, with buy-in required from banks, landlords, tenants, receivers and local authorities. And I'm going to give you a couple of examples where I see this happening, and some of them are pretty obvious, to be honest with you, but hopefully it will give you an indication of how things will look and be different in the future. The first and most obvious one is ghost estates, and every speaker today has touched on them. Ghost estates in some areas may need to be demolished, others may be finished, or they may be used for social or private purposes, but it depends on the quality, the location and how much is complete. There are certain towns in Ireland where there are 4 or 5 ghost estates with 4 or 5 different developers and 4 or 5 different lending institutions and 1 local authority. And clearly these people need to come together and decide which are the viable ghost estates and which are not. They need to have an adult conversation, and they need to support some and demolish the other. And it is not until you start dealing with the problem of ghost estates around the country that you can move on. The local authorities obviously have a huge part to play in this, and that's what I'm talking about, cooperation and coordination. At the moment, we've been sitting in paralysis, and we've been doing nothing about the problems, and there are consequences on it. Another area of cooperation and coordination relates to the issue of planning. And various planning authorities have, in some ways, been focused on a form of idealism that is at variance with market demands. And that's not to say that you ignore evidence-based planning. And I accept that there is an absolute requirement for managed and controlled planning, but it cannot and should not be blind to what the market requires. If you look at Cork Street and the street behind me, it is just not feasible to generate retail uses where there are no retail demands. 73% of the retail units in newly completed developments in Cork Street are and have been vacant. In addition to that, there are numerous older shops which remain vacant. Clearly, the desire from the local authorities' point of view is to create animation at street level. But there must be more inventive ways of dealing with this, and it is clear that it has failed. Another example of where market-led planning is required is the insistence by many authorities for higher density developments in locations where the demand is for lower density living. So they're insisting on apartments when actually people want houses. Unless there is a shift in thinking, there will be certainly limited demand for such land, and there will categorically be no development. If you look at Grafton Street and the surrounding areas around Grafton Street, there is a clear disconnect between what the local authorities want and what international retailers in particular desire. I think most people would accept that Grafton Street is now in decline, and part of the reason, but not the only reason, is that international retailers can't get the floor plate sizes that they require, but they can get them in suburban locations and shopping centres. And it is resulting in the country's prime retailing street losing out on investment and prestige. We have to accept that Dublin is not Rome, where small shop fronts are cute and acceptable, and that we have to trade with what people want. To be fair, the decline in Grafton Street does not by any means just rest with the local authority. And again, if I can bring in the theme of coordination and cooperation, for a high street, be it Grafton Street or any high street around the country, for it to survive, it must grow and have a very clear vision of where it wants to get to. It needs a coordinated planning and management approach to get it there. And if you were to assume that any of those high streets around the country were in single ownership, like a shopping centre, it would have a vision, it would have a strategy and a direction, and it would choose what it wanted in a particular space to fit with that vision and proactively go after it. This is where cooperation between landlords and tenants and the local authority in a unified approach is imperative. Quite simply, most high streets in Ireland have evolved organically through the decades without adapting to the changing consumer. As the crisis has hit, they've had little vision or guidance to see them through this challenge. High streets, frankly, have quite a lot to do, and in contrast, out-of-town centres provide consumers with a clean and attractive destination, cheap parking, healthy retail mix, things to do, and the right marketing to get them there in the first place. Another area where cooperation and coordination will become a prevalent feature is the issue of negative equity and tracker mortgages. It is my view that there are a number of homeowners who are frankly trapped. They may have good jobs, their families may have grown, but they're not in a position to move and take advantage of the low prices that are in the market. Some are trapped as a result of negative equity, and some are trapped because they have tracker mortgages which cannot be replicated. It would seem to make sense to me that all parties should come together and find an acceptable solution. I'm aware, obviously, that there is a mechanism to allow people to transfer their negative equity, but perhaps people should be allowed to transfer their tracker mortgages. It may be that some of the banks would not necessarily be happy with this, but on the basis that they have written down the loans and the losses on their tracker mortgages already, there should be nothing to stop them. Finally, at the beginning of the presentation, I mentioned that I believe funding is not freely available. I say this as a result of numerous dealings I've had with potential buyers and from our own internal teams selling property on a day-to-day basis. In most instances where we are selling properties, the purchasers are either cash buyers or they are obtaining their funding from overseas lending institutions with whom they have a business relationship with. The availability figures in relation to mortgage lending are somewhat limited, but we do know that in 2011 there was less than 15,000 drawdowns during the entire year. This compares with over 200,000 drawdowns in 2005. We also know in 2011 that only 2.46 billion euros was lent in comparison with 34.1 billion in 2005, and we don't have the figures about how much was paid back to the banks on those years. I heard one commentator suggest recently that at current lending levels we are now back to 1974. Despite the inflow of exchequer funds to Irish banks, it is clear that they have been unable, and actually understandably unable, to release funds to residential purchasers. The government should now consider placing a sum of money with a separate financial institution, who controversially may not be an Irish bank, with the sole purpose of residential lending. It may be that somebody like An Post would be a good candidate for this, and given the layoffs in the banking industry, there would be a widespread availability of suitably qualified individuals who could implement this. And the reason I suggest this is because it feeds into the domestic economy, and it's not just about the estate agency business. For every house sale, there's two solicitors. There's movers, there's new furniture, there's paint, there's carpets. And it's a way of getting our domestic economy back moving. In summary, as we look into the future, it's very difficult to know where we're going. There's no doubt that we are going to face new challenges and we are going to expect the unexpected. And I think of a colleague of mine who's here today, John O'Sullivan, who certainly faced the unexpected one day when he went out to show a house and found that somebody had stolen the roof.